Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. This is going to be the first opportunity for markets in Asia to react to a downgrade of the U.S. credit rating by Moody's. It was last Friday after the New York close that Moody's stripped the U.S. government of its top credit rating, cutting it to Aa1 from AAA. Bloomberg's Michael McKee says this may not mean a lot for U.S. markets, but
there could be some portfolio rebalancing based on this. But most contracts say reference U.S. government debt rather than specific ratings for it. So that could prevent forced selling. However, it does mean likely higher interest rates. We'll have to keep an eye on the yield curve, and that raises the costs that the U.S. government is going to have to pay to service its debts.
That is Bloomberg's Michael McKee. Now, Moody's cited the failure of successive administrations to deal with rising U.S. debt and deficits. The firm also cited interest payment ratios at significantly higher levels than similarly rated sovereigns. I guess you could say the move was hardly surprising since both S&P Global and Fitch have already taken similar steps. Joining me now for a closer look at this and other stories in the marketplace is Larry Tentarelli. He is the Chief Technical Strategist at Blue Chip Daily Trend Report. Larry, thank you for making time to chat with me about this. Give me your reaction to the Moody's downgrade.
Doug, thank you for having me on. So I believe the Moody's downgrade is going to turn out to be a non-event. As you said, two other rating agencies have already downgraded the U.S. over the years. And as we look at the market reaction right now, the S&P futures are down about 0.6%. 10-year Treasury yields have moved up about 5 basis points. So we may see some short-term volatility, but I don't think that this is going to be a major event whatsoever.
But the timing comes as Congress debates even more unfunded tax cuts. Do you think this in any way influences the conversation in Washington?
It might to a degree, because I do think it puts upward pressure on bond yields. So to a degree, it might, because it is still a major news event. So to a degree, yes.
Well, you mentioned the upward pressure on bond yields, which reminds me of the situation a while back with Silicon Valley Bank. Do we have to be concerned if we get a backup in yields to a meaningful degree about the way in which some of the regional banks or other financial institutions are exposed to U.S. Treasuries?
We'd need to see 10-year yields break out over 4.80. Right now, they're trading at about 4.48. And I don't know that this is enough of an event to push yields to that breakout level. So it's always a possibility, but I would say it's a very remote possibility that we get a major breakout in yields from this.
Let's talk a little bit about what's been going on with the global economy as the Trump administration works to rearrange or re-engineer global trade. How do you understand the tariff story at the moment? Are we closer to a resolution, do you suspect, or does this have the potential to drag on for a while and do a substantial amount of harm to the global economy?
My expectation is somewhere in the middle. So my expectation is that this will not be a quick fix. It could drag on as far as the process for a few months or longer. Scott Bessent recently said that he thought it would take 2 to 3 years to get a full China trade deal. So the process could take a little more time, but I think what the markets are really focused on right now is the news cycle. And about 6 weeks ago, the markets had really priced in worst case scenario and a global economic slowdown. Over the past few weeks, because of positive news headlines that have come out, I think a lot of pressure has been taken off global economic expectations. And I think the markets are adjusting right now to the expected tariffs.
We talked about the possibility that this Moody's downgrade will negatively impact U.S. equities. You cited the S&P E-mini futures contract a moment ago. But if you look at what happened Friday, equities capped their second best week of the year. Fair amount of optimism maybe about the trade deal, and I was struck by the fact that the market seemed to overlook not only the slump in consumer sentiment, but a real spike in inflation expectations. I think we're at the highest level right now in about 40 years. What is the risk, do you think, for the U.S. equity market in the next 3 to 6 months?
The two biggest risks that we face, number one would be if there was any major walk back in the progress that we've made with China in the trade negotiations. That would be number one. The second biggest risk, if for some reason the economy started to slow down drastically, if the jobs market started to weaken, which it has not, the labor market's held up very well. I think the disconnect with inflation is inflation expectations are based on consumer sentiment. But if we look at the actual data that's coming in, CPI has come in below forecast for the past 3 months. PPI came in negative last week. So the consumer expectations may be bearish, but the actual data that's coming in has been trending lower.
But you could make the case that we have yet to see the tariffs really bite. I think Walmart last week said it was going to raise prices. The president kind of pushed back against that notion. Is there the risk that these tariffs will, in fact, produce higher inflation that the market is right now maybe underestimating a little bit?
Yes, there definitely is. The tariff effect is going to have a lagging process as far as when the tariff kicks in, when the tariffs kick in. So although we haven't really seen higher inflation yet, this is going to be a process, not an event. So we do have to stay cautious over the next few weeks or over the next few months that inflation doesn't break out higher.
So when it comes to the Fed, what is your thinking? Do they take a very, very cautious stance here? And if the market right now is expecting maybe 225 basis point rate cuts, that's about right? Maybe the risk is that we get fewer than that?
Yes, I believe that the Fed is on hold at least until September. The Fed funds futures market is pricing in the first rate cut in September. But I believe the Fed can be very patient right here. They don't have to be in a hurry to cut rates whatsoever. The economy is holding up well. The labor market is very strong. And inflation is still above the long-term forecast. So I believe that the Fed is going to be very patient. I believe they're going to want to see no negative effects from the tariffs. So I believe they're on hold for the time being.
I'm curious as to how you're viewing opportunities offshore right now. Are there places to put money to work?
Definitely. So China has turned up recently. The Taiwan market is back over the 200-day moving average, and they're heavily tied to semiconductors. Semiconductors had a very strong week last week. Taiwan semi was very strong. India has turned up recently over the past few weeks. That's back over the 40-week moving average. And Korea's been acting very well. So I'm seeing opportunities in China, India, Korea, and Taiwan.
I'm curious, Larry, about the measures of conviction that you use in your work. What are they?
What I look at is price trends and weekly price moves. So what I'm seeing in the S&P 500 and the NASDAQ 100, very, very strong conviction moves. What we saw last week is the S&P 500 and NASDAQ 100 both closed over the 40-week moving average for the first time in quite a few weeks. They did it with a very strong move. Both indices were up by over 5%. The 40-week moving average is rising. The 10-week moving average is rising. So when I look at these weekly chart trends, these are very strong moves that we're seeing.
Larry, we'll leave it there. Thank you so much for joining us. Great insights from Larry Tentarelli. He is the Chief Technical Strategist at Blue Chip Daily Trend Report, joining us here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. We're seeing currency market reaction to the downgrade of the U.S. credit rating by Moody's. Both the Japanese yen and the Swiss franc have strengthened. The dollar, meantime, is weaker. Earlier, Treasury Secretary Scott Bessent downplayed concerns over the U.S. government's debt and the inflationary impact of the tariffs. On Sunday, he said the Trump administration is determined to lower federal spending and grow the American economy. Now, Bessent's remarks come ahead of the G7 finance ministers meeting this week in Canada. That's where U.S.-Japan trade talks are expected. For more, we heard from Tobias Harris. He is the founder and principal at Japan Foresight. He spoke earlier with Bloomberg's Yvonne and Avril Hong.
We talked about what's at stake here, but it seems like the narrative has shifted on how Japan can approach these talks in this third round. What is your expectations on whether Japan can actually secure a long-term trade deal with the U.S.?
You really have this fundamental question of what is the U.S. willing to put on the table? Because I think Japan has been very clear that it doesn't want a one-sided deal. It wants automobile tariffs, it wants steel tariffs, it wants aluminum tariffs to be on the table, up for consideration. And I think the messaging from the prime minister and other members of his government has been is that this is pretty much a non-negotiable position. And so, frankly, until we see movement from the U.S. On those tariffs, it's going to be really hard to get a deal done, because I think Ishiba's put himself in a position where he can't really climb back on that.
Yeah, you mentioned about the auto tariffs. I mean, that 25% tariff on Japan auto imports is still there. What do you think Ishiba is thinking? Do you think his administration is willing to sacrifice the domestic agricultural industry to win back those tariff reductions when it comes to autos?
I think it just depends on the overall deal that's on the table. And in fact, I think, we've now seen some reporting hinting that the Ishiba government might be open to lower auto tariffs, but not completely removing the new tariffs that were introduced. But the overall package, for now, we have not really heard what the Trump administration is really willing to put on the table. And frankly, I don't know if we've heard that the Trump administration is even happy with some of the potential agricultural concessions that that have been discussed as possible from the Japanese government. I mean, the overall picture, the idea, what exactly are they looking to get out of Japan in this? Is the goal, getting rid of Japan's bilateral trade surplus with the United States, or is it market access for U.S. goods, whether or not that results in eliminating that trade imbalance with Japan? And until we get to that point, I think it's really hard to say what exactly does an agreement between these countries look like.
Tobias, what about sort of like the domestic audience at this point? Because there is also an upper house election coming up. Does that in a way play into trade talks?
I think it absolutely does. And I think it certainly has affected Ishiba's sense of timing, that, not wanting to have certainly he doesn't want a bad deal at all, but a bad deal right before the election, I think, is going to be bad news. I think, a deal that saves Japan's automakers, that limits the impact on agricultural producers, I think, that would be a great deal for him to announce right before the upper house campaign. And I think, he's looking, to have some achievement that he can take to voters. But if that deal does not look like it's materializing, it's much more likely, frankly, that talks will drag on past the upper house elections, that, Japan is better off waiting to get a better deal than to have something inadequate to put before the voters in July. So, it really depends on what ultimately is on the table. But clearly, the fact that Ishiba doesn't want to be going to the electorate having to face accusations that he's thrown Japanese agricultural producers under the bus, that's not something the LDP wants to have to run on in the upper house election. So it really depends on the substance. It's not there's not a one size fits all agreement here as far as the LDP is concerned.
What about the currency? I mean, how is that figuring into negotiations, you think?
I'm skeptical that currency has that much of a role to play. It's been coming up. It's been floating around. It's been mentioned as possible. I don't think at the end of the day, I don't think a deal. I don't even know what a currency deal really looks like, considering that Japan has not been devaluing its currency. If anything, when they've intervened, it's been to strengthen its currency. I don't think the Japanese government is really in a position to put monetary policy on the table. I think they're going to resist that. And when it comes down to it, they're also not going to agree to some sort of specific numerical target for dollar yen either. So ultimately, I don't know what exactly a currency deal looks like. I don't know what Japan is willing to bargain in favor of a currency deal. And so ultimately, I think, they'll have these discussions, but when it comes down to getting some sort of trade deal done, I don't think currency is really going to be an important plank of that.
Yeah, Tobias, you talk about the relationship between the U.S. and Japan. Japan is very dependent on the U.S. when it comes to security. There's a $63 billion trade surplus with the U.S. I got to wonder, though, how much leverage then does Japan have going into these talks?
I think we're seeing that, it's trying to find sources of leverage, but ultimately, and some of it is the structure of bilateral trade. I mean, it's not that there's an easy fix, to make, either Japanese buy more American stuff or, to get Americans to buy less, other than leaving the tariffs in place, right? I mean, if the U.S. is really serious about reducing or eliminating the trade deficit with Japan, I mean, ultimately, the best thing is going to be leaving the tariffs in place and encouraging Americans to buy fewer things from Japan. That's a little uncomfortable for Japan. In general, though, I mean, I think, what has been interesting over the last several months, watching the Japanese public's response to, the Liberation Day tariffs and the auto tariffs and so on, I think there's a feeling of frustration and betrayal, and I think it's in some ways stiffened the Japanese government's spine. I think there's a feeling that, in the past, perhaps the expectation was, the government has to do whatever it takes to make the U.S. happy, to keep the U.S. engaged and committed to Japan. But I think there's a feeling that, there were certain promises made during the first U.S.-Japan FTA talks with Trump in 2019, and there's a feeling that those promises were broken. There's a feeling that without really having a clear sense of what the U.S. actually wants, there's a sense of, the U.S. being unfair and being arbitrary. And so therefore, I think there's an expectation that, if Ishiba just, placated, did whatever it took to placate Trump, that actually could backfire domestically in a way that I think would not necessarily have been the case in the past. And so this is something of, uncharted waters. We don't really, the way that domestic politics are playing out in this situation is a little different than what we've seen with the U.S. in the past.
Tobias, thanks so much. Great to get your analysis. Tobias Harris, founder and principal at Japan Foresight.
Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.